We are on. Hello, everyone. Welcome to the first session of the reality of the derivatives market with Elie Ayache. Elie was born in Lebanon in 1966, trained as an engineer at l'École Polytechnique of Paris. He pursued a career of option market maker on the floor of MATIF from 1987 to 1990 and LIFFE from 1990 to 1995. He then returned to the philosophy of probability and to the technology of derivative pricing and co-founded IoT33, a financial software company, in 1999. Today, IoT33 is the leading specialist in the pricing of convertible bonds, in the equity to credit problem, and more generally in the calibration and recalibration of volatility surfaces. Ayache has published numerous articles on the philosophy of contingent claims. He is the author of The Blank Swan, The End of Probability, 2010, and The Medium of Contingency, an Inverse View of the Market in 2015. I'm going to pass the camera and microphone to Elie to start the class. Go ahead.
All right. Thank you, Mohammed, for this invitation and this opportunity to try to present my trade and the industry and all the problems that occupy me to everyone. Once again, I do apologize. I thought that I had time ahead of me to set up two computers that I needed in order to show you not just my face, but I was thinking that I could show you the actual software that we develop in my company, if only to illustrate concepts that I'll be talking about, such as what derivatives mean and what stock that move around mean, what volatility means. So apologies for that, and hopefully in the next session the technology will be up and running more smoothly. So today, unfortunately, we'll resort to a very primitive technique, which is I will be showing you, if possible, the screen of the other laptop with another webcam. In the meantime, you have my face to look at, and because it's really the first session, so please let that be a kind of introduction and overview, and please do interrupt at any time that you feel, because I have not prepared like a course which is structured and systematic, because I don't know what kind of crowd you are in terms of getting ready to hear about the market. So really, we can start this as a conversation, and I might go ahead and tell you things that might sound a bit technical at first, but don't worry. I mean, it will be a conversation where we circle around the topics if needed. So to go back to what I'm up to, today I'm speaking to you from the offices of my company. Can you all hear me clearly, by the way?
Yes. Yes.
I suppose that any one of you can interrupt at any time and ask questions, right? So you're all online. Okay. Okay. So I started my career really before creating this company as a trader in the stock exchange back in the late 80s. And these were the days where banks in Paris, because I started doing my business in Paris, these were the days, late 80s, when banks were very keen on hiring engineers like myself, because I had graduated from engineering school. And the reason was that in those days, derivatives were starting to become fashionable. And derivatives, of which you may not be aware of experts today, but hopefully as time goes by, I'll explain more and more, are instruments that are traded in the markets, but as opposed to basic assets. So here you can already detect an opposition between a basic asset, I'll explain what that is, and a derivative which is written on that asset. So derivatives, as opposed to basic assets which trade on exchange, the derivatives require math, and they require that you understand mathematical formulas, the most famous of which is the Black-Scholes formula. So the Black-Scholes formula is something that I will talk about a lot during this whole class. So I'll come back to it very often. And this is a mathematical formula which is not very complex, except that it's technical. So there are a few mathematical functions involved. I had in mind, of course, if I'm able to share screens later, to show you the intuition behind the formula. But what you have to keep in mind today is that it's a mathematical formula. It was discovered in 1973 by two people in Chicago, Black-Scholes, and it was the first workable formula that allowed everyone to evaluate derivatives with respect to the basic asset. Because a derivative, as I will explain again, is something that has a basic asset which underlies it. So the derivatives goes hand in hand with the underlying asset underlying it. And the formula establishes a very astonishing link between the basic asset and the value of the derivative. And once that formula was shown by Black-Scholes in 73, and by the way, the theoretical paper that they published, a lot of journals in finance refused it at first because nobody in those journals had any idea how important this formula was going to be. So it was published by a minor publication at some point, but very quickly Wall Street caught on the game, and the formula started being widely used, and the markets of derivatives really entered into its modern industrial phase starting from 73. So that formula, which by the way earned Black-Scholes the Nobel Prize in 95, really is the start of my business as an industry. So that was in 73 in Chicago, and in 73 a lot of other things happened. There was also the oil crisis, as you know. There was also I think that in 71 the dollar was no longer pegged to the gold standard, so the gold standard was abandoned in currencies. So these were the years where actually people, I mean, the value of things, starting with the value of the dollar itself, starting no longer dependent on something fundamental like gold, and this is when things started floating freely in the markets. So this is, if you will, those years, 73 is the year when the price of the stuff became the fundamental entity as opposed to value. And this is the opposition between value and price is something very important to my mind, because in everybody's mind, the value of something is linked to the fundamental worth of that thing. So usually when you evaluate something, when you evaluate the stock of a company, you feel like you want to link it to what's inside the company in terms of what the company is producing as goods, etc. So people think of valuation of companies, as opposed to when the stock price of the company goes and trade, the stock goes and trade on the free exchange. The only thing that matters starting from then becomes its price, and the price is offered to speculation, so the price can vary with no longer any link with what people may relate to as the value of the company. So think also when the gold standard was abandoned for the dollar, that something like that happened also for currencies. So currencies also starting floating irrespective of a fixed index towards respect to gold. And this is like the start of a new, if you will, philosophy and era, where actually the price of stuff was just open to the free exchange, and it had to fluctuate freely just by the mechanics of supply and demand. I know from experience, because I've been, talking about this a lot to people who are not expert in the fields, that it might shock a lot of people that price should be the only thing, and it could no longer relate to any way of valuing the thing. And the price, of course, if it's fluctuating freely, creates something which will be very important in all our discussions, which is volatility, because a price would be volatile. So anyway, so this year, like between 71 and 73, was the year when the free exchange of things starting becoming the only game, and as soon as the formula of Black-Scholes was shown, because Black-Scholes showed a direct link between the value of the derivative and the stock price underlying it, as I said, options no longer were thought of as gambles, because now there you had a mathematical formula linking the value of the derivative to the underlying stock. And this is why also in those days the CBOE, the Chicago Board of Option Exchange, because of that formula, thought that options were no longer pure bets that no one knew how to value, because now you had a mathematical formula to value them. So the CBOE in Chicago made options tradable again on its floors. So there's a conjunction in 73 of both the mathematical formula and both the fact that in Chicago options came back into favor to be traded on the exchange. Why came back into favor? Because options were more or less banned. They were considered very bad instruments after the 1929 crash, when people were buying puts and calls to speculate on stuff, and some people believed that people who bought put options, and I will explain what a put option is later, were basically speculating against the economy. So options between the Great Depression and 73 were kind of out of favor, and they were more or less banned from trading, and the regulator considered that there were bad instruments that you should not put into the hands of people, until in 73 Black-Scholes showed a mathematical formula which basically related the value of options mathematically to something more reliable than the option, which is the underlying stock. And this is really where the date when options are starting coming back in favor and starting being traded. So
I have a question, which is actually Christelle's question, and it's a very important distinction. She asked that the formula was discovered and not invented, right? Because this relationship existed. It's just that these people discovered it, or really was it invented?
Yeah, I mean, it's a very good question. No, it was discovered, but of course it's a mathematical model. So you have to do to model the behavior of the stock in some way, which I will explain. And when you model the behavior of the stock in some way using volatility and Brownian motion, then you discover the formula. I mean, we have time, so I'll spend all the today, if you will, because I don't have all the technology that I wanted to show you immediately, but we can spend the whole session discussing this formula because it's important. But to go back to my personal story, all I wanted to point out is that this formula is mathematical. For the first time, something important happened, because something which was basically traded in the exchange, so basically nobody knew what the value of it was, because everybody thought that the value of options were up to just speculating about that, what that value was. Suddenly it became the output of a formula, and suddenly market makers and banks started manufacturing derivatives, because they thought that they had a formula which they could use to transform the price of the underlying stock into the value of derivatives, and starting offering prices for derivatives. And I was hired by such a bank in 87, so 14 years after the formula was discovered, because by then in France and everywhere, this had become an industry. So this is how I started a career in 87, because I was trained as an engineer. And the formula, as I will try to show you if I can, is mathematical. So it requires that you have an understanding of what a partial derivative is and what not. And for 9 years, to finish quickly my personal story. So for 9 years, I was a trader of options or derivatives, options and derivatives. Options are the simplest case of derivative, which I will explain later if you don't understand. So for 9 years, I was an option trader, 4 years in Paris and 5 years in London. And when I was fed up with that, because basically you go to an exchange and you are standing here with like hundreds of people shouting all the time in order to buy and sell. And it's very frustrating, because if nothing happens, you do nothing, and you are waiting all day that there is some action on the floor for you to be active. So I stopped being a trader 9 years later, and I started reflecting about the business, and I took like a leave for like a couple of years during which I started becoming interested in philosophy, and this is important in my in my career. Why? Because I will show you that the derivatives market, if you really believe in it as an industry, will lead to a kind of contradiction to the assumptions underlying the formula. So because there is a contradiction and also a paradox, which everyone is aware of today, but still hasn't been solved, this is what started me into thinking about why probability theory and why the Black-Scholes theory, which is based on probability theory, which is at the basis of the formula, why ultimately it's totally incompatible with the net result of it, which is the derivatives market. So this paradox between the derivatives market as such and the formula and the underlying math that's behind it is what personally drove me to philosophizing about probability and drove me to writing the two books that Muhammad has mentioned. And at the same time, because I had retired from trading and I was aware of the technology, I created the company ITO33 to try to build software and algorithms which were more advanced than Black-Scholes. So this is the software that I was trying to plug into the class today to show you. So the software that we have in the company today is probably the most advanced software that really connects you with the market of derivatives and clearly shows you where there is a problem with the formula. I'll go back to all that in point of details, but I'm giving you an overview. So today I find myself both developing technology that is at the cutting edge of what the derivatives market are today, and this technology that my company is licensing to players in derivatives everywhere. And I know because we've been showing the technology to a lot of people around that it is still, I mean, the problem that we are addressing, remember that in the description of the course, I said Black-Scholes solved a problem, which is the problem of evaluation of derivatives, and created the problem, hence the paradox. So we know that this problem is still an open problem. It's a fascinating problem, which ultimately, after having thought about it deeply, philosophically, I don't believe that the solution will come from like a new formula that you will come up with. This is important because you have people in the field that still believe that all you have to do is find a new formula which is better than Black-Scholes in order to solve the paradox. But actually what happens is that no matter what formula that you have, the market of derivatives will grow up on you one layer and it will create a paradox and the problem at the next level. So there's a kind of infinite regress here, which is I find fascinating. And this infinite regress of why the problem will never go away is what takes me into basically a kind of radical revision of the whole paradigm that is underlying the formula, which is the probability paradigm. So that's why in the second instance, the second instance of the presentation of the course, I said that if you really want to become serious about it, you have probably to go as deep as the foundations of probability theory and see what's not working there in order to understand the market. So today I find myself developing this cutting edge software which really presents the problem and shows the problem that exists of the derivative market. And on the other hand, I've been writing books and doing a kind of thinking about how to philosophically understand the problem. And I believe that this is what got Muhammad's attention and thought that it might be interesting to try to talk about this to non-experts, because I believe that none of you is really an expert in derivatives. But at least the problem that derivatives generate can be interesting. Why? Because I think that it relates to something very deeply ingrained of thought, which is the schema of probability itself. So the schema of what is possibility, what is necessity, what is contingency. So these are problems that are more general than just the derivatives. And I believe that in derivatives, those problems receive a very accurate definition and hopefully solution. But however, the problem can be interesting to everyone. Not to mention that derivatives by themselves are something massive. So it's not derivatives market are not something that are happening in a remote corner of the world. Everyone is more or less aware of their existence, and it's important that I mean, people become more aware of the reality and the problem that they have. Okay. Do you have any question at this point? Because I think that
I can ask some questions, but I think we should first like open it up to the students in the class to see if somebody has any question, any basic question, any. Yes.
Okay.
Okay, so let me ask. Nobody's volunteering to ask a question. So, the first question will be for people in the class. Everybody knows at least what derivatives are, right? So we don't need to go over this like simple definition, right?
Maybe not. Maybe I should explain again what the call and the put are. Or
yeah, so maybe call and put and just like a general definition of like derivatives. But my question was, so if derivatives without the Schultz formula were in prior to the 1920 crash, and then they were thought of as like this black box thing that was in control over, and they were like not allowed to be traded officially, at least in Chicago. And then if the invention or the discovery of the formula allowed them to come back to the market,
yes.
Why after the 2008-9 crash they did not be abandoned again? What made them to remain? Because we all know that the crash that we experienced had a lot to do with derivatives, but we don't see them being abandoned or questioned as much as we thought they would right after the crash. So the first part of the question is some definition of the derivative, and the second part of the question, is like this is question about like their validity and how they remain in the market.
Yeah,
and then I was just curious about what led you to philosophy, because it seems sort of strange to go from derivative markets to philosophy. It seems quite a leap. So I was just curious, like, what led you in that direction and what philosophy interested you?
Yeah, okay. So let me answer quickly the second question first. I mean, the philosophy is not, is actually a philosophy of science. So because I had studied some philosophy of probability. So it's the philosophy of probability theory, the distinction between objective probability, subjective probability. So I'm interested in the probability that underlies the evaluation algorithms that we use in finance, such as Black-Scholes. It's all based on probability theory, as you find in textbooks. However, and this I will explain, it so happens that if you push the conclusion of the formula to its end, to its purpose, which is with the output of the formula, which is a calculation which is made up out of probabilistic computation, you end up with the value of the option. Now, if you trade that option in the market, the price of the option will, because it's trading in the market, deviate from the value that you have just computed and ruin the formula. So there is a kind of paradox here, where by using the Black-Scholes formula, which is based on probability theory, using it to trade options, you ruin the assumptions of the market, as I will explain later. And people usually think that it's fine. It's just that practice doesn't conform to theory. So people in my field are usually happy to say, okay, no problem. I mean, I'm using a theory which is Black-Scholes, and this theory is based on probability theory, which everyone agrees is a very, very established mathematical theory. And then I'm finding that the option price in the market is deviating from the theoretical value that the theory is finding. It's not a problem. It's a usual case of failure of theory in practice. It's a usual case of a theory being, not pretty much accurate to conform with practice. Well, as I say that, no, it's not the same situation. And I need philosophy because the purpose of the theory is to price the options in the market. The purpose of the theory is not just to evaluate the options on paper or to evaluate it theoretically in the classroom. The purpose of the theory that is being developed by banks and by people like my company is to use it in the market, and the market by definition is going to change the value of the output. So it's not an accident, if you will. It's not as if someone is finding out a theory of the physical world and finding that experiments are contradicting the theory. Here, no matter how sophisticated you make the theory, if you use it in the market, it's usually going to be contradicted. So there's a kind of paradox which more or less resembles what happens, say, in quantum mechanics, where if you observe something, by observing it, you are going to perturb it, and therefore there is a kind of paradox. It's not the same thing, but it's similar in kind of something deep. As I said, people in the whole field, there is no philosophy trying to handle this paradox. People in the field, the only theory that you have is the theory of Black-Scholes and sophistications of it. And on the other hand, you have people trading the options in the market using tools that we develop. And there is not any thinking that try to link the two and to find an like, if you will, a Uber kind of point of view where you make sense of the contradiction or of the paradox, and then try to make sense of the derivatives market as such. And this is where I found that you needed philosophy, because I found that really, if you think deeply through the problem, what needs to be questioned is the whole archaeology of thinking that underlies probability theory, which is recognizing that you have identifiable scenarios beforehand to which you assign probability. So the basic of postulate of probability theory is that, first of all, you have to agree with me what are the possible scenarios that are going to unfold. Say the underlying stock is going to go up to 100, to 200, 300, 400, or go down. So these are the scenarios, and you assign probabilities to them. And this is the paradigm of probability, of course. However, I found that in order to make sense of the fact that no matter at what level you go, there is always a paradox, you need to actually go down into the foundation and say, maybe this idea of assigning probabilities to identifiable scenarios is the thing to question. And this is a criticism of the notion of state. It's the criticism of the notion of is it possible to list exhaustively the scenarios that can happen, or should the future be open? How can I run something which is like a quantitative model or like a technology in a situation where I don't know beforehand what are the scenarios that are going to occur, etc. So this becomes more of a meta-probabilistic thinking. You have to think a little bit beyond probability and question the fact that maybe probability is not the last word. Maybe there's a theory which has to be more comprehensive than probability theory, as Kolmogorov has formalized it, for instance, in order to account of what's going on. Quantum mechanics, by the way, is not the same thing at all, but it is similar in the sense that quantum mechanics is a meta-probabilistic theory. So it's a case where you go beyond the setup of mind that Kolmogorov has shown in quantum mechanics, and you show that there is some hidden assumption, or there is some presupposition in Kolmogorov that is not always true, and even in nature it's not always true. And so you have to become critical of the probability theory and come with something which is a meta-probabilistic view, and this gives you quantum mechanics. I might comment on this later, so don't worry, I'm just trying here to give you an overview of the ramifications of the problem. You know that quantum mechanics, for one thing, is metaphysics already. So for somebody to understand quantum mechanics and to understand what's amazing about it and what the paradox that something might behave like a wave sometimes and sometimes like a particle, and you can make experiments, and there is no way that statistically you can understand the experiment by just a distribution of particles being statistically distributed in one way or the other. So to try to understand these paradoxes, very quickly in quantum mechanics, you find that you have to go down and question the metaphysics of, meaning the thing that is behind physics, and question notions like, what does object mean really? What does property mean? What does a state of a system means? So these things that are taken for granted by physicists usually, and have been taken by granted by all the physics applying classical physics, Newtonian physics, you find that those notions, like notion of state, notion of stable object, notion of property. These are the things that you need to put into question in order to become more general about them, by saying maybe there's a notion which is more general than an object. Maybe there's a notion that is more general than the state of a physical system. And this is where you reconstruct the universe, where you can start to understand what's going on in quantum mechanics. So I'm saying that quantum mechanics in itself is already a criticism of physics. And I'm saying that in finance, especially when you add derivatives. So in my whole philosophy, derivatives are really an integral part of the problem. You cannot imagine, in my sense, a financial market without all the complexity of derivatives underlying it, and without pushing to the limit the infinite regression that I said, that no matter what you did, the problem will always beat you. So I'm finding that in order to make sense of that, you need also to question basic notions such as what is the state of the system means, and what does it mean to apply a probability to that state.
Elie, I have something to ask before you move away from the question of philosophy, and that is, you know, my interest in the seminar and the discussions that you opened up with your books is how this relates to the notion of temporality and the order of past, present, future.
Yeah.
And I think that's a very important philosophical question, and aspect of the work that also, I think it maybe answers a little bit of Chuggy's question of like, what is the relationship? So I don't know if you have any comment on what does like thinking of derivative can do to our understanding of time?
Yeah, I mean, please, Mohammed, take a note of that question, because this is a major question that I plan to address thoroughly. But my quick answer is that, of course, derivatives are all derivatives are predicated on the future. I mean, to write a derivative, if you are buying or selling an option, buying or selling a futures contract, it's always contracts that have a delivery date in the future. So even though the price of all those things is going to change every day, but in the definition of the derivative instrument itself, there is a time dimension. And obviously, in the theory of pricing of derivatives, you have, as I said, to sample the future scenarios. Now, what can happen with time is, to very quickly give you the punchline here. Probability theory, the classical one, puts you in a situation where you identify the future scenarios, you apply probability to them, and you do forecast. So you are always, before the event, trying to forecast the event, and then after the fact, you find that all your prevision was completely wrong because a new event happened that wasn't part of the list of scenarios that you have imagined. This is the famous black swan thing. So my whole point is to say that derivatives is a way of solving that problem, that even though it looks as if the price of derivatives is today, is taking place today before the actual expiry of derivatives, the massivity of derivatives market and the paradox in the derivatives market, which I will try from negative to turn into positive. So my whole movement here is to try to understand that the paradox is not a negative thing, but it actually can be used as a positive means to put yourself, let me give you here the punchline, it's as if you are before the future. However, it's as if, as of today, everything that could happen ex post is already happening today. So it's as if you manage somehow to solve the problem that you have in probability theory, where no matter what happens ex ante, you can have no idea what's going to happen ex post. And I'm saying that derivatives solve that problem, even though I'm situated today, not in the future. It's as if I'm already in connection with the event, together with all the massive, unprecedented things and completely unforeseeable things that the event is going to bring. It's as if it's happening today in the derivatives market. So it may sound obscure today, but this is the kind of twist of time that I can hope to show you in the end. So that's, but again, we will expand on this, because this is like this is the basic, one of my major lines of thinking. So why, I mean, one of my ways of putting it is to say that in the derivatives market, you do not predict the future, because prediction is something that you leave to probability theory, or you leave to algorithmic trading. So algorithmic trading is a situation where you have an algorithm that's supposed to forecast the market. So I'm against that, because that doesn't apply, because as I will show you, probability theory with the schema of thought where you have scenarios and you assign probabilities to them, so that whole frame of thinking, which is the frame of thought of provision, will fail in derivatives, and it's replaced by something which is more massive than that, something that is more compatible with the massivity of an event, in the sense that the event will destroy any provision scenario that you have. And it's in this sense that I need a stronger word to deal with the future than provision. And I, for instance, say that the future shouldn't be predicted, it should be written. So for me, for instance, the derivatives market is a technology of writing the future, not of predicting it. So again, I mean, I'm giving you here a few ideas without justifying them, but I believe that we will expand on them later. Now, let me go back. I
don't know if you have time to go back to the questions I asked, which was a basic definition, and then why in 2008 they were expanded.
Exactly. I was planning to answer that now. So let us rewind, and the answer quickly is that in 2008, the failure came from derivatives that are bad derivatives, which are complex derivatives. And typically, the crisis in 2008 was generated by the subprime and by the CDOs. I don't know if you've seen the movie The Big Short. Have you seen that movie?
Yes, I've seen it.
Yeah. So basically, the character played by Christian Bale is like a rocket scientist who all of a sudden discovers that those derivatives that everyone think are fancy and everyone is investing in them, which are the subprimes, when he goes through the listing of what is actually underlying them at the beginning, and he goes really into the details of all the single loans that underlie the subprime, and he discovers that the calculations that banks are doing are very simplistic, and that they are based on a very simple assumption. And should that assumption fail, then basically the market of the subprime should collapse. However, the subprime and the CDOs, the collateralized debt obligation, are not calls and puts, which are the derivatives that I trade in my business. My business, even though the algorithms that I'll show you are the most sophisticated today, still relate to what we call vanilla options. So the options that we deal with in my company and the customers and our company deal with, what are called the good derivatives, are the derivatives that were in existence even in the 19th century. And before the crash of 1929 were already traded without the Black-Scholes formula. But these are calls and puts are simple derivatives, and because they are simple, they are good derivatives. But it doesn't stop the market of those derivatives to become a little bit more complex. Why? Because Black-Scholes was a major simplification. So Black-Scholes, as I will expand later, managed to reduce the richness of all the prices of derivatives to a single number, which is volatility. So this is why it's as if Black-Scholes, it's as if at some point when Newton discovered the law of gravity, Newton reduced the whole complexity of the movement of stars and planets to a single variable, which is the law of gravity. And all you needed is to apply a single formula to explain all the complex patterns of movement in the stars. So Black-Scholes is exactly the same kind of situation. Suddenly, you discover a formula where a single number, which is volatility, is enough to explain all the prices of all derivatives in all their calls and puts, in all their differences. And that went on for 14 years until the crash in 87, when the formula was contradicted and when models more advanced than Black-Scholes, like the ones we develop in my company, were needed. So the market of derivatives became more complex than Black-Scholes had thought. However, the derivatives remained simple. We still are talking about calls and puts, as opposed to the massively complex derivative that were the only play in town during the subprime crisis, where you have no model really to objectively give you the value of those. So those are bad derivatives because they are complex, and these were the ones responsible for the 2008 crisis. But calls and puts, they weren't really concerned by the 2008 crisis. On the contrary, people who are trading calls and puts in Chicago, of course, volatility exploded and they made more money than ever, and their market became more liquid than ever. But it wasn't really related to the crisis of 2008. The crisis that calls and puts, the good derivatives, the simple derivatives, took place in 87. 87, the crash of 87, which were actually My first day as a trader on the floor happened to be October 19th in 87. So that was the major crisis that hit the simple options. And as I will show you, paradoxically, it did not end the life of those options. On the contrary, it made their markets more alive and richer. Why? Because it broke the formula of Black-Scholes. Black-Scholes, remember, had one number ruling everything. So because one number is a bit contradictory to the existence of a market with all its richness, so on the contrary, the breaking the formula of Black-Scholes was, according to me, the real birth of the option market, not its end, it was its beginning. Mohammed, are you still there? So does that answer your question?
Yes, I'm here.
Okay, so now that we have spent,
maybe you can talk about put options and
and call options.
Yes, and call options. Yes.
Okay, so let me try to do two things here quickly on the other computer.
Also, if you see the text bar on the side, there's a conversation going on between the students in the classroom. To see it, you have to go on the sidebar where the green icon was and click on the blue, and you see the text. And there's some questions there too, or some comments that you might want to like think of or respond to.
Okay. So I will now, what I'll do, so say again, sorry, I click on the, which one? This one here? Hello?
Yes, on the blue. It's above the green one for sharing the screen. And then on the side of the Google Hangout, there's like a button, and then the text going on there is a little bit of like an in-class conversation.
Okay, okay. We'll see. We'll see later. So let me go back. Okay, so now let us, now that you have more or less chatted, and I hope that I gave you at least the breadth of topics that interest me, and I'm not sure that all the terms that I have used were clear to everyone, but again, I will spend the whole class and the whole time trying to discuss them. So let us go back now to the basics and try to define what a derivative is, what an underlying asset is, what volatility is, and more importantly, what calls and puts are. Calls and puts are basically all I need, more or less, in this class to get to the problem going and to really show you all the problem and all the paradox that happens. And after calls and puts, we'll talk about the next level, maybe derivatives that are still, I mean, simple enough, etc. So let me go back to one thing that I said at some point, which is that you no longer have value, you have only price. So that's very important. So as soon as you abandon any idea that a stock, say the stock of a company like Google or I don't know what other company, Lenovo or SocGen is trading, as soon as you give up the idea that the price of the stock as it's trading freely in the stock exchange is linked to a valuation of the company or to a fundamental value, you end up with the idea that the price is free floating, and it corresponds to what Keynes has described as the beauty contest. So the beauty contest, according to Keynes, is, and this is how Keynes referred to the beauty context in order to interpret what is going on the stock exchange. So he said that to understand how the price of stocks are being formed on the stock exchange and how they fluctuate, it's as if you are asking a crowd, the crowd there, to vote not for the most beautiful woman, but to vote for the woman that they think that everyone else will think is the most beautiful one. So you see what I mean? So it doesn't matter the fundamental beauty of that woman, if you will. All that matters, in order that you who are playing on the exchange or you who are investing in that stock, is that you kind of self-referential loop that you think what the majority of people, what the majority of the crowd are going to think is the most beautiful stock and is the most beautiful company for you to buy the stock in order to make profit if the stock rises, etc. So immediately you can see that as soon as you take away the illusion of fundamental value, because I personally believe that there is no fundamental value anyway. But as soon as in the schema of thinking you say, well, there is no ground any longer, there's not a value that I relate to, and it's all up to what the crowd thinks that the other people are thinking. So as soon as this whole thing, you understand how self-referential it is, and therefore you have all kinds of very frightful effects that can enter, like you are going to mimic what other people are going, and therefore immediately it will mean that there will happen speculative bubbles as well as crashes, because suddenly if the crowd converges towards everyone wants to buy the stuff, it will burst upwards, and if suddenly you find there's no more buyers, it will collapse. So this self-referentiality, you can show almost mathematically that the consequence is that the price of that stock, or the price of anything really, is going to be completely random. So here it is. I mean, the beauty of the thing is that in finance, in the stock exchange, as soon as you accept the principle that there is no such thing as value, there is only price, meaning there is only what other people think that the price is going to be. As soon as you have this self-referential, you immediately get randomness. So you don't need, in the markets or in finance, a further grounding for the notion of randomness. The market itself is equal to randomness. I mean, that's very fundamental. That's why, for instance, later in the next class, I will show you that if you think about the market as almost an alternative to the schema of thinking of randomness and probability. You don't need in the market to think of, like in all the textbooks of probability, of something like a big urn from which you are drawing balls or you are drawing something randomly. The existence of the market itself is random all the time, because otherwise there is no market. Anyway, so as soon as you accept that fact, that randomness is going to be the basic thing, what happens is something very amazing. It's as if we are saying there is no more value, there is no such a thing as value, there is only price, and the concept of there being a price, meaning the concept of there being a stock exchange, the concept of there being a crowd that is only following rumors or following what the next guy is going to be, etc. This thing, all I'm saying is that the whole concept of the market becomes equal to volatility.
I have a question for you, sir.
Yes.
So is there a formula for randomness that you use that you're challenging, and are you sort of offering a new definition for randomness? Is this something that you've come up with, or is this just common knowledge?
No, that's common. No, that's common knowledge.
Okay.
All I'm saying here I will show you later. There's a major book that was written by a French mathematician whose name is Louis Bachelier in 1900. So as early as 1900, Louis Bachelier published a book. The title in French is Théorie de la spéculation, or the theory of speculation. So that's the first book where Bachelier assumes that because the stock is random in the way that I have described, there is no other thing to do than apply probability theory. And Bachelier is known in mathematical circles because he is the first who heuristically has defined Brownian motion. So Brownian motion is the major thing that I'm driving at when I said volatility. Brownian motion is really the random process that you really need to understand, because that's Brownian motion is really the basic of everything, and it's really the marvelous thing that is at the basis of all option pricing theory, etc. But again, this is standard. This is not yet the criticism of probability that I will do later. This is very standard understanding of randomness. The only comment that I said is that I find it interesting that as soon as you admit that there is a market, there is randomness. You don't need to say that there is a deity or some divinity who is drawing random lots from an urn for me, because it's already immanent in the market that you should have randomness. That's all. That was my comment. So I was saying that if you follow me in the sequence of thinking here, I said there is no fundamental value, there is only price, and price by definition is going to be random. And what is very important in the market is that it is random on any time scale. So that's an important notion, because if you understand it, you will get what the whole idea of random motion is. So what does it mean, random on any time scale? It means that if you look at the evolution, the time evolution of a stock price, as I'm sure you've all seen on screens where they show you how stock price moves. Maybe I can draw pictures here if you can see. So you've all seen graphs like that, where the stock becomes at 100 and it moves like this. Okay. So when you see a jagged picture like this one, which describes the time evolution, you might think that it's only because I'm not looking very finely at the graph, that if I zoomed in the graph and looked at the behavior of the stock, not every second, but every millisecond or every millionth of a second, you might think that I might find a scale at which it's no longer unpredictable and where I can make money ahead of time. And this is what algorithmic trading and high-frequency trading are trying to do. They are trying to guess at a certain scale whether the stock can be, if only for the next millions of seconds, be predictable in order to buy it and make a profit. And you find, unfortunately, that there is no scale at which it is predictable. So this kind of curve in which there is no scale at which it can be predicted is a very astonishing mathematical entity, and it's called the Brownian motion, and it's very important, as I will discuss later. However, the sequence of thought that I was trying to show here is we've just said that there is no value, there is only price. Therefore, the fundamental concept of the market is the concept of volatility, meaning a stock price can only be volatile, meaning it can only be unpredictable at any time scale. And the most popular theoretical representation of such random process is Brownian motion, whose main coefficient is the thing that we call volatility, which measures how random the path is. So now if you follow me, it's as if I'm saying that now the fundamental value of the market is volatility. So it's funny. We are saying there is no value, there's only price. The concept of price itself means volatility, means that the price fluctuates. Then it means that the only, the fundamental, somehow the value of the market, the fundamental value of the market becomes volatility. So volatility becomes the thing. And strangely enough, you find that derivatives are evaluated after volatility. So all I'm saying is that the funny idea that the stock price should have no fundamental value and have only price, this means that the stock price is going to be volatile. With that, you have all you need to, strangely enough, build a theory of valuation of derivatives. So you end up at the next level, even though you were saying that as soon as I'm trading in a market, there is no such a thing as value. If you say that as relates to the underlying stock of IBM or of Google, you end up with a theory of valuation of the derivatives. So you end up contradicting the paradigm of the market where nothing should have a value, but you should only have price. So this is, to me, in one word, why Black-Scholes will lead to paradoxes, because it is actually a theory of valuation of derivatives in an environment which is the open market, where we are saying from the beginning that there shouldn't be anything like a valuation theory. And yet you find that there is a fundamental valuation theory of options, which ironically enough, what is the fundamental value in it is the volatility of the underlying stock.
But
so yes?
Sorry, but volatility itself can be measured, because volatility has a definition and we all know what volatility means, right? But in the context of the market, you can actually consider it as itself a thing that can be somehow measured or speculated upon. Am I wrong?
This is exactly what I'm saying. I'm saying that the ironic reason why Black-Scholes were famous and all the banks start using it and start hiring engineers like myself, and there's this whole industry of people making markets on derivatives, is that because with the Black-Scholes formula, suddenly in an environment where up to now everybody knew that there was no value for anything because there was only price, suddenly you had a formula which based on nothing else than the fact that there is no value, because it's based on nothing else than the fact that there's volatility, provided, as you are saying, Muhammad, that we measure volatility. That's the major thing that Black-Scholes have hidden from everyone. It's true that in the Black-Scholes formula, you need to know what volatility is, and they didn't tell you how you can compute volatility, but it's completely true. It's completely true that the basic assumption of Black-Scholes is that eventually you look at the graph of the underlying stock and you can measure volatility historically, and I will tell you how you measure it because it's a statistical measure, so you can measure it statistically. And here you are now equipped with a formula, with a strict, rigorous mathematical formula, which gives you what? Which gives you all of a sudden means of evaluating options. So options, strangely enough, ironically enough, calls and puts became the thing that suddenly you knew how to value, when up to now in this context we all agreed that there is no value of anything but only price.
Can you please give us and also for people who watch these videos hopefully in the future, a working brief definition of options?
Yeah,
because I don't think that happened.
It is. Let me switch. Yeah, I'll switch to that other camera. Here it is. Can you see the screen now?
Yes.
Okay. So this is Brownian motion. Can you see it? Hello?
Yes, we can see it.
Okay. So this here is just an illustration of how, starting from let's say here, whatever at time 0 the stock price is. This here, what I'm drawing are different realizations, different possible trajectories that the price of that stock could follow from 0 to 1 year, say. And the reason I'm showing it to you is to show you how at any scale that you look, there is some randomness. Okay? And this here is a very famous graph in all the textbooks of finance, which is what we call the payoff function, the profit from buying a call option. So that here is a call option. So what does it mean? It means that if you, so this here, this axis here is the stock price. So this here is a representation how in dollars the stock price is, the value of the stock price. If you want to buy the stock, you will be having a payoff like that, where for every dollar that the stock makes upwards, you make a profit which corresponds to that movement. Okay, are you following? Okay.
Yes.
Hello? Okay. Now, a call option is the capacity of buying exposure to the stock price going up without the downside. So suddenly a call option allows you to floor your losses on the downside. So you buy exposure. If you bought not the Google stock, but if you bought a call option on the Google stock, you buy exposure to the rise of the stock. So you will make money basically if the stock went up. However, if the stock went down, can you see here the flat line? Your losses are floored. You lose no money on the downside. So you have what we call an asymmetrical payoff. It's not a straight line, because if you had bought the Google stock naked, as we say, you would lose money if the stock went to 0, and you would lose everything it went down. Here, by buying the call option, is a derivative instrument which is written, as we say, on the underlying stock, that allows you to gain exposure only on the stock going up and limits your losses on the downside. You ask me, how can you such a fancy instrument? The answer is that someone, a market maker of options, is going to sell it to you, and is going to sell it to you for a premium. That's why the Black-Scholes formula is here to instruct the market maker at which premium he's going to sell you that call. And this is the reason why, maybe you can not see it here because my finger, this is the reason why this line here is really under the water, because this is the premium, in this case it's $5 that you should give up in order, so this premium here is you, the investor, what you should give to the market maker in order to have your losses limited and only to gain exposure to the upside. And because you are paying upfront this premium you will never recover, so you lose the premium once and for all, and your hope is that the stock will rise as you think, and you will make your profits are completely unlimited here on the upside. You see what I mean? So that's a call option.
So just to rephrase, the formula allows for the setting of the premium also.
Exactly, the formula of, so these kind of diagrams, the diagram that I'm showing you here, so this would be the diagram for a put option. I'll come back to that later. These diagrams are what we call in my trade the payoff functions of the derivative. So if you have, again, a stock which is moving randomly like this one, it's moving randomly because we said that from 73 on, everything is moving randomly, even the dollar. And if it's moving randomly, it's moving randomly at any time scale. And this is Brownian motion, which is the simplest way of modeling this randomness. And Brownian motion is characterized by one number, which is volatility. So you have that. And now that the underlying stocks are moving randomly, people become interested in, insuring themselves against losses on both ways. So they buy instruments like these, and derivatives, they are characterized by what I called here payoff function. So you need in the derivative a completely explicit and clear description of what the derivative is going to pay you as money when it expires. So this derivative is here, this one, which is a call option, will pay you any dollar that the stock will trade at above 100. Except that, as I said, because you start out by paying the $5, that's why the whole diagram is shifted downwards by $5. So this call option gives you every dollar that the underlying stock trades when the option expires above 100, it's in your pocket. And if the stock trades below 100, you are not liable to any loss. And you give away from the start $5 to own such a derivative. And this $5, how you compute it, how the market makers compute it, is by using the Black-Scholes formula and applying the volatility number in it. And do you have any question here, or?
Pretty good. Maybe we can move to the other option.
Yeah. Yeah. So a put option is, imagine the reverse situation where you already own the stock. So you have already a portfolio of a stock or a portfolio of stocks or whatever, and you want someone to give you money, to give you the right to sell it back at a determined price, to give you money if the stock should go down. So you want you don't want to make money if the stock goes up. So here you are paying a premium as well. So there is a kind of premium that you are paying no matter what. However, on the upside of the stock, you make no money. All you want is, should the stock go to zero here, that the option that you've bought, which is a put option in that case, pays you an amount of money in order to actually insure you against losses in your portfolio or against losses in your holding of that stock. So it's symmetrical. An alternative way to explain both options is to say, well, imagine that I don't want to buy the stock today. I can go to the market and buy it today at the current price. I don't have the cash today, or I want to buy it in 3 months for whatever reason. However, because it is random and I don't know at what price it will be trading at in 3 months, I want somebody to guarantee to me that no matter what happens in 3 months, when I want to go to market and buy it, I would buy it at 100 no matter what. So you are buying what we call a call, meaning the right to purchase the stock at a predetermined price. And of course, if 3 months from now, you find that the stock is trading below 100, you don't need to exercise that right. You just go on the stock exchange and buy it at 80 if it's trading at 80. All you're interested in is that should the stock be trading above the price that you want to be guaranteed, that somebody finances for you those dollars above the trading spot. So that's a call option. And conversely, if you want to guarantee for yourself the capacity to sell something that you own at a predetermined price and not to incur losses, you would buy a put option. Okay. So here
it would be great. So basically, you described to us two different types of option. One, call option and put option, right?
Yeah.
And then could you please, if it's possible, explain how is it's identical and differs from just simple insurance?
It's the same. It's exactly the same. It is insurance. So that's why you are paying a premium. So you have contingencies that are going to face you. You know, but that because the stock is random, anything can happen, and typically the stock price can be trading above the price that you want to guarantee for yourself, and you want somebody to insure you against the stock rising, or to insure you conversely against the stock trading below the price, and that's insurance, and you need to pay upfront an insurer a premium, and the guy is now bound by a contract, which is the derivative contract, is bound to give you any money that you should need to guarantee the insured event. So meaning the market maker here, if the stock is trading at 200 and he wants to buy you that money, it's out of his pocket that he's going to pay you because it's his loss, he's insured you. However, the only thing that he has upfront is the premium. So the whole idea is how, once you've paid that insurer the $5 premium in this case, how the guy is going to be clever enough to use the money that you have given him as a premium in order to be able to pay you back whatever the liability which will be, which, as you can see, can be unbounded. So he can be liable to pay to you an infinite amount of dollars if the stock should rise. The same for this guy. You pay a premium, and this guy is going to guarantee any losses. So again, I mean, the Black-Scholes formula is giving the randomness that we have here, giving Brownian motion, what is quantitatively the premium for those options.
Can I ask a question about the volatility?
Yeah.
I was under the impression that, if there's a high volume of put options being called on a stock, this also increases, it feeds back into the volatility, correct?
You mean if a lot of people
are betting against, if a lot of people are betting against the market, wouldn't that change the volatility? Or is my assumption mistaken here in that, like, the randomness that the Black-Scholes formula is calculating to give you a number, this is just not based on what the actual volume or types of options that are on the market currently?
No, it's completely correct. I mean, if a lot of action has taken place on options, and as we say, there is a lot of open interest. This is the technical word. If suddenly, for some reason, because people in the market are predicting that there would be some war happening on some major event like a crash, suddenly you see that the open interest is rising on options, then potentially it will become a self-fulfilling prophecy, because potentially all the guys, the market makers like myself, I used to be one, who are short these options, who sold insurance to all the other investors, should the event start to happen, it will accelerate. Because suddenly all the people who, like myself, are short the insurance will do their best to hedge the options, and I didn't tell you how to hedge the option. And in order to, for instance, if you are short a call option like that, the call option as a market maker, as soon as the stock price is going to trade above the level at which you guaranteed the investor, you as an insurer are going to run ahead of him to buy the stock in advance in order. So that's what's exactly happening. Conversely, for the put option, you are going to sell short the stock as soon as it reaches the level below which you have guaranteed the investor. So I
see this happen on the market all the time when the stock price is at like some 90-day low, and I'm trying to make a call I'm trying to open a long position. All of a sudden I see all these shorts liquidating, and it doesn't make any sense to me because it's already at a low, but it's just people shorting the market. That answers my question. Thank you.
Yeah. So I mean, for instance, the 87 crash, now we know that one of the major things that triggered it were people who had, for the 14 years that had elapsed between the discovery of the formula in 73 and 87. So the Black-Scholes formula became so popular that people had by then devised program trading algorithms where the algorithm itself would provide automatically insurance for the portfolios. So you see what I mean? Gotcha. So the computer itself will tell whatever the bank how it should guarantee to the investors the fact that the portfolio that they owned would not incur any losses. So basically, it's as if the bank had shorted all the options to their investors, and as soon as the event started unfolding, the algorithm themselves triggered massively selling the stock short in order to hedge the options, the put options that the banks were short, and this is what accelerated actually the movement. Okay. So let me here go back a little bit to try to maybe comment also on how volatility and the stock price relate to each other. Can you all see the graph here that I have? Hello?
Yes, for sure.
Okay. So here, I'm not sure how I'm going to do this. So here we have a stock that is starting at 100, and I'm showing to you one possible realization of the Brownian pass. What I'm going to do is increase the volatility here to say 70%.
Yes.
Can I wear my... This is a...
Hello?
Hello, go ahead. Sorry for the interruption.
Yeah, no problem. So here I changed the volatility to 70%. And you see how the path, or if I change it here to 100%, you can see how the path is going to be more and more hectic. You can see? So that's increasing the volatility. If I drop volatility to 0, you see that the path of the stock is completely deterministic. So when you have 0 volatility, can you see the number that I'm changing here? When you have 0 volatility, the stock price has no longer any randomness in it. And it's as soon as you put some volatility, even 2%, you will see that 2% already generates a lot of noise and volatility, not to mention 20% or not to mention 30%.
Really quick, the input to this is historical data, correct?
No. Here I have a computer simulation. So here I have simulated on my computer starting from 100 here, starting from 100, and with these numbers, the computer is generating the path for me. But I guess my aim here is to show you that even though if there is no volatility, the stock will rise deterministically, if you can see, from 100 to 103. Why is it rising to 103? Because I assumed that there is an inflation of 3%. The interest rates are 3%. If I put 10% here, interest rates, the stock will rise, if you all can see, from 100 to 110. So this, if we're all living in a world where there is no volatility, if this was only money in the bank, if you will, so not stocks, if you are putting money in the bank and the interest rate in the bank were 10%, you would be guaranteed over a year that if you had invested 100, you will end up with 110 at the end of the year. So that's a situation where your investment is on a non-risky asset, or it's money in the bank, in other words. Now, all I'm saying is that it's enough that the stock or the investment be volatile, enough that you'd be invested in some stock which is volatile. If I put 60% volatility, no longer 0, what I'll try to show you here is that it might very well be the case that it doesn't grow above 100. So here, it ends up below 100 at the end. And if I simulate another path. Here, for instance, it rises up to 180 and goes even below 100. Or here again, here, even though the interest rates are 10% and everything should in theory grow 10% a year, the mere fact that you are adding 100% volatility, you end up with your investment at 60 or at 80 here. So think of the Bitcoin. For instance, the Bitcoin today, the volatility of the Bitcoin is 150%. Are you following me? So all I'm trying to show you here is, even though you know for sure that the safe investment is going to grow and make money anyway, volatility can completely turn the picture upside down and have your investment actually be very, very poor than not. Okay. So these were only graphs to show you Brownian motion. Okay. So let's go back to this. Do you have any question at this point?
Maybe if there's anything on the sidebar, if somebody has a serious question on the sidebar, maybe it's time to interrupt, especially questions by Christelle, because I saw some earlier stuff. Christelle, do you want to?
Otherwise, I will start explaining to you how Black-Scholes came with the formula. And
I think Christelle wants to say something, right? Because you unmute yourself.
Hey, yeah. Can you hear me now?
Yes. Move the monitor a little bit lower so we can see your mouth better. Yes. Thank you.
Yeah.
Yes.
Cool. So yeah, I think I had a question or two before on the sidebar, but just to understand this concept of randomness, you mentioned that that the price is random on whatever time scale, right? And
yes.
From the little understanding that I have of the sort of traditional view of the stock market, I would have imagined that the longer the time scale would be, the more we can kind of the more applicable the idea of value becomes, the more we can sort of predict somehow based on, I don't know, fundamentals or whatever.
Yeah, you're absolutely right. You're absolutely right that I mean, in the long run, the stock always rises. So somebody who had invested in the stocks 100 years ago would have become millionaire no matter what, no matter how many crashes happened in the meantime. So it's true that overall, on a very long periods of time, the stocks rise. However,
right. But the way you word it, it seems that you don't really think that, you know, it has anything to do with the sort of, I don't know, fundamental underlying whatever results of the companies, but that it's just like I don't know, some sort of a function of the market. Or
yes, I mean, it's true that I'm a bit radical here on purpose in order to make the concepts more clearer. It's true that if you are really investing in the long run, definitely you have to do some analysis relating to the economy and relating to the fundamental value of the companies, etc. But the scale that I'm interested in is the scale on which the market is ticking every day. This is the scale. So on that scale, no, there is only, as Keynes was saying, only what the crowd out there is doing. And it's a scale that can be a little bit larger than a day, because you can generate speculative bubble that can, you know, last for 1 year and then it crashes, etc. So it's true that in the long run, definitely, I mean, if the economy is doing fine, you should expect over 100 years, I mean, the stock to go up, and this is why people invested in Bitcoin, for instance, today are all convinced that in 20 years the Bitcoin will be worth $1 million, because I mean they assume that the Bitcoins are going to replace the dollar. So therefore, everything that is being exchanged in the whole world against currencies will be done in Bitcoins. So they do the simple math by saying, well, if the Bitcoin was the limited stock of Bitcoin that we have, which is 21 million Bitcoins eventually, if that is going to replace the whole mass of money that we have today, they end up with the value of one Bitcoin being $1 million, say, and they don't care if it goes to zero in the meantime, because they know that in the long run it will go there. Of course, I mean, it's not true that the Bitcoin will replace dollar. I don't think so. I mean, that's open to debate. We can debate it. But these kinds of people are really looking in the long run, as opposed to people as soon as now, because now, unfortunately or fortunately, the Bitcoin became itself a speculative asset like any other. So it became a kind of ordinary asset. It left the whole utopia of replacing the dollar. So that there is a kind of irony in it. And now you can see that for the last maybe month or so, the price of the Bitcoin is oscillating between $8,000 and $11,000 with a volatility which may be 80%. So it's more or less now behaving like the graphs that I've shown you. And this kind of time scale is the one that I'm interested in. I'm interested in a time scale where typically you have a trading desk in a bank, an investment bank, who hired engineers like me and said, okay, you have 1 year to make money by buying and selling options. So this kind of time scale, which in the end goes down to a time scale of a day. So I was supposed as a trader on the stock exchange to have more or less my position neutral at the end of the day and make money day after day. So therefore, the time scale for me was 1 day. And on that kind of scale, what I said applies, meaning it's only randomness and it's only volatility that is the measure of thing. And Brownian motion is again the simplest mathematically rigorous representation, where you represent a trajectory of the price of things, because we require two things. We require that the price trajectory of the stock be continuous, meaning because we are always assuming that there is always liquidity enough in the market, there is always present at any point of time enough buyer and sellers so that the market can go on forever. There is no major disruption of the market where everything and the price collapses. This happens, for instance, in 87, October 19th. In that case, there was a price discontinuity and the market opened that morning and there was a major gap in the price. So that is not Brownian motion. It becomes something which we call jumps. But Brownian motion is saying, well, this is business as usual. The market is perfectly well balanced, if you will. At every second, you have enough buyer and enough sellers to clear each other and to correspond to each other. So the price is continuous. There is no disruption in the functioning of the market. However, it is continuous, yet it is random. So this whole concept that you should be drawing a continuous line, like the one that I drew here, yet that line should be random at any scale, is something very, very counterintuitive if you think about it. That's why Brownian motion, it's not until 1920 or something that it was shown mathematically that it existed. Meaning we weren't sure, mathematicians weren't sure that Brownian motion could actually exist, mathematically speaking, until Wiener showed it existed in 1920. When Bachelier in 1900 published his book, he did not call Brownian motion by its name because he did not know. I mean, it became known as Brownian motion by other people. However, the kind of assumption that he made was completely, as I said, heuristical. He did not give any mathematical proof that such a thing existed, and it was very counterintuitive because you have both the property that it is continuous, so you feel like you can draw it with a pencil on paper without letting your pencil leave the paper, so it's continuous. However, in actual fact, you cannot, because no matter how much you magnify the picture, at no point, at no scale, will a single straight line appear. So actually, Brownian motion is what also is known as fractal curves. There is no scale at which the curve is smooth enough for you to say where there is now a trend somehow. Because if at any scale there was a trend, meaning there was at some scale a place where the algorithm, high frequency algorithm, could identify a smooth slope, then the algorithm could buy the stock ahead of time and make money. And the assumption here is no, nobody can make money at any point scale because there's always competition and it's random at any scale. So if you add the two requirements, meaning we want the curve to be continuous with no breaks and to be random at any scale, you end up with this very non-intuitive entity, which is Brownian motion and which exists. And mathematically, it's only by abstraction that you can show that it exists. But there is no way that I can draw it for you. Here, what I showed you on the computer is something that you are seeing on some scale, and it looks like that because I have only chosen one scale. However, if I magnified the picture, it is always random.
But sorry, but when you say random, just to it's something that Teno also asked in the chat. Do you mean is it? Are we talking about sort of randomness in the mathematical sense, or the sort of pragmatic sense that we have no idea what influences the prices, and therefore for all sort of practical purposes the movement is random? But actually, if we, I don't know, like in a sort of science fictional model, if we had, I don't know, some sort of AI or big huge machines that could sort of predict the psychology of like every agent in the market.
Yes.
Would, like, in that case, it would not be random, or I don't quite know how to. Yeah, like are we talking about randomness in the purest sense, or are we talking about randomness in the sort of practical sense that
no, I mean,
we just don't know?
No, I mean, it's like flipping a coin. So, I mean, the one way of also representing Brownian motion mathematically is by approximating it by what we call the random walk. Let me try to show you here again by. So here, if you have a stock that can go up or down every second, then sorry about that. No, I don't have it here. Okay. So imagine that at every node of that tree, I start with the stock here being at 100, and at every node, I flip a coin to know if I'm going up or down. At every node, I flip a coin. If you are flipping a fair coin, it's completely unpredictable whether you go up and down. So this kind of movement here, if you compose it until the end, and if you reduce the time scale, you end up with Brownian motion. Typically, you end up with that. So it's really random in the sense that. Go back to this. At no point in time, no matter what computing power you have, no matter what the people who are playing in the market have, no one can. You can only assign probabilities to the fact that it goes up or down. So it is really like flipping a coin, and there is, I mean, one definition of randomness, for instance, if you go back to the basic foundation of probability, people in the beginning of the 20th century wanted to formalize probability, and one of them, there was Kolmogorov and von Mises trying to formalize probability. So von Mises took as a definition of probability is that if I take a sequence of zeros and ones, say every time I flip a coin, if it's heads, it's 0. If it's tails, it's 1. So I have to have a sequence of zeros and ones which extends to infinity. And if I compute the frequencies of heads and tails in the whole sequence, it should in the end meaning infinity, because I'm flipping the coin infinity, converge to 1/2. So if the coin is fair, it means that half of the occurrences are heads and half of the occurrences are tails. However, it's not enough to say that, because if you took a sequence of zeros and ones where it's every other one is 1 and every other one is 0, meaning it's periodic 0 and 1, surely the frequencies will be half and half in the end, but this is not random because it's periodic. So you have to add another requirement, and the other requirement that von Mises has added and which defines randomness is that at no point from the past that you have already observed up to now, meaning the zeros of one that you have already occurred, could you predict whether the next one is going to be 1 or 0, head or tail. So, and this mathematically was a bit tricky to define. They managed to do it, and Kolmogorov even gave it a more rigorous idea. But randomness nowadays in mathematics is more or less well defined, and I mean, ironically enough, that you find that in the theory of randomness, the mathematical theories, you find that they use algorithms. So it ends up by saying that a sequence is random is that if it's not possible at all to develop any algorithm that would for sure make money out of the sequence. So these kinds of ideas in math are very common, where it's not that you have to devise all the algorithms. You can show results where you show beforehand that if there was a situation where no algorithm could possibly be constructed, such as to predict the sequence, in that case, it is random. Why I'm saying this? Because I'm saying that by definition of randomness is that no algorithmic trading should occur. So it's the contrary, if you will. If you ask me what random is, I will tell you it's such a thing, such that no algorithm could predict the behavior of stock. You see what I mean? So I don't know if you want to call that theoretical or practical. Obviously, the two are linked, because as I said, even the theoretical definition of randomness ultimately is linked to practice, because ultimately it's going to say not any investor who is betting against that random sequence could make money in the long run. And I personally find it fascinating how money, which you may think is a very practical and very tangible and very material concept, interferes in theory. So that's one of the major things why I think finance is important, because even in a purely theoretical or mathematical domain where you think about probability and randomness, you find definition there which relate to money and betting. Once again, one of the universal definition of if a thing is random or not today, mathematically speaking, theoretically speaking, is that no one could devise an algorithm that makes money consistently on the long run. Of course, we are not excluding the fact, if you are familiar with Nassim Taleb Black Swan, that you might be a lucky fool, meaning you may create a hedge fund, and because you are lucky 5 years in a row, you make money because you are just lucky, and all of a sudden, because people see that you are making money 5 years in a row, they all think that you have found the algorithm with which to make money. And the whole conclusion of Nassim Taleb's book is to say, no, this is on the contrary. He is a lucky fool. It's just by chance that you've seen him make money 5 years in a row. Why? Because all the other people who lost money have disappeared. Only one guy remained who had made money 5 years in a row, and suddenly people becomes convinced that this guy has found the magic algorithm whereby to predict the market. But wait a minute, on year number 6, he will lose 10 times more money that you've ever made before, and that's it. So it's of course, I mean, by a sheer strike of luck, you can make money, or you can have 6 occurrences of heads in a row. But randomness, by definition, is that no one can devise a methodology or an algorithm to beat the market. And as I said, one of the simplest and most beautiful mathematical representations of randomness, the simplest one, is Brownian motion, because the whole randomness of the pictures that I've shown you are represented by a single number, which is volatility. And it is that single number that Black-Scholes have used to evaluate options. Any questions, or shall we move to?
But you know,
I had a question. So you're saying that so the in terms of the time,
Sorry?
I think he's having internet troubles because he's over in some top of some mountains. Okay. But I'm going to replace the question. Most of us in the class, if not all, come from the side of the humanities. And I'm going to pretend that like this is also the question of the rest, is that we all see some kind of like direct link between sort of like tangible things in the political, cultural, social climate and a notion of volatility. So it's volatility. It's not like this thing that happens in a vacuum, right? Because volatility is linked to these very, for us, tangible things, right? So how do one account for how politics, culture, and society impact volatility in a ways that then it will impact the price?
So what's bothering you is the fact that it's volatility. What that is the trouble, or
no? Volatility is linked to politics and culture.
Oh,
in a way, and how does that get accounted for?
I mean, I have maybe the fortune to be, you know, I'm only looking at finance. I don't know. I mean, of course, politics is involved in finance. However, in finance, volatility, as I said, is the assumption. You can't get anything going in finance, as I said earlier, unless you first admit volatility. So volatility is the given, and I even called it the fundamental concept of the market is volatility. And my whole problem, I mean, of course, I'm very modest here. I'm not doing politics. My only concern in my whole career and my whole thinking is to actually try to address the issue of how is it that in an environment where I said that volatility is the major thing, I end up with a theory, which is a theory of evaluation of options. And when that theory is going itself to be put to usage, and the problem that it will generate then is that the options themselves will admit of prices which are volatile when the theory is saying that they are deterministic. So
okay, let's just put a funny and more tangible example. You know what I mean? The election of a president in one of the largest economy, if not the largest economy in the world, whose like tweets can have such an impact on, or even political decisions can have such an impact on the economy. How do you calculate the volatility of Donald Trump and how that, because you know he has to be factored into volatility, for instance, or other elements like that, right? Like, do people in the market think of like a tweeting president as something that can increase or decrease the volatility, or no, it does not come into the picture?
Yeah, I mean, again, the beauty of the thing is finance. It's only numbers. I don't care what's causing the movement of price. It might be the tweets of Donald Trump. It might be things happening. As soon as the financial problem hits the theories that we are applying and hits the algorithm that we are applying, the only thing that for us counts is the volatility number of the stock, the volatility number of Brown in motion that I have showed you. And that number I can estimate historically by looking at the time series of prices and computing what in statistics we call the standard deviation of the returns of the price. So you can very easily, on the history of prices of stocks, compute the volatility. And now there's a leap of faith, which you make if you use the Black-Scholes formula by saying the volatility number. I don't care what's the cause of volatility. It might be the tweets of Trump. It might be war in the Middle East. It might be whatever. I know that a stock is volatile. I compute its volatility by computing statistically the standard deviation. And now the leap of faith is that I believe that this volatility number is going to persist through time, through the next week or through the next months or so. Why? Because now I plug it in the formula to evaluate a put option that I've shown, whose graphs I've shown you earlier, which mature or expire in 1 week or 1 month on 1 year. So the whole exercise after Black-Scholes is the following, is that suddenly Black-Scholes showed a way how you can mathematically rigorously compute the premium that you are paying up to the market maker for options if only knew one number, which is the volatility of Brown motion. Black-Scholes assumed that that the stock was Brown in motion. Remember that I told you that one of the major ideas in the assumption was that the stock is continuously trading and there are no gaps. If, for instance, you start making assumptions that the stock trajectory can have breaks in it, and it can jump up or down all of a sudden, with like in discontinuity, you can no longer apply Black-Scholes. So you have to apply algorithms that are more sophisticated than Black-Scholes, and these are typically, as I will show you in the next sessions, the algorithms that we have in our company. Black-Scholes, again, the reason why it worked so beautifully is that it so happened that one number, which is volatility, and one model, which is Brownian motion, was enough to give us what we require in finance, which is we need the stock price to be unpredictable at any scale. We don't want anyone to make money out of a stock with no algorithm. And this is enough by just prescribing volatility. And now the leap of faith, which is underlies Black-Scholes, is that, as I said, even at the beginning of this whole session, is that Black-Scholes didn't tell me where I get the volatility number from. I know that I have to plug a volatility number for the stock in the formulas, but they didn't tell me where to get it from. And what people do is get it from the past. So they will look at the past history of prices that have traded on the Bitcoin or that have traded on Google or whatnot, compute volatility by statistically applying the formula for standard deviation, and then, and here lies the major leap of faith, they say, well, we will assume that for derivatives that I'm going to sell or buy as a market maker, meaning for the next month or next year that those derivatives are going to engage me, that volatility will persist. Whereas if you now said, well, no, guess what, volatility itself can change over time, or not to mention the fact that Brownian motion cannot be valid and there may be jumps, etc., you can no longer apply Black-Scholes. So this everybody understands, and people who are using Black-Scholes are aware of the limitation of the model. But when the problem becomes interesting is that even if in our narrative we believed everything that what Black-Scholes are saying, meaning there is this single volatility number that I may have computed from the past history or not, or maybe God told it to me or whatnot, and I plug it in my formula, the purpose of the exercise, the reason that I'm putting it in the formula is to evaluate an option. And as I said, the moment that formula was discovered, the industry was born and all the people starting trading option. But then if you are trading option, then obviously you cannot be using a formula or an algorithm to give the value of something, because as I said, as soon as something is trading, its value is going to move away from the formula. So this is getting to the heart of the problem that I have. So to put it in a simpler terms, the technology and the formula of Black-Scholes gave us ways to evaluate options. However, these options, we were not going to evaluate them just in theory. The whole purpose was to evaluate them in the hands of market makers to trade them. However, if you are going to trade them, meaning you are going to trade them away from the output of the formula. Because if the value of the option were ruled or governed by the formula, why trade them? I mean, you just, a computer will do everything for you and you don't need to trade them. So what happened, and the reason why, ironically enough, the whole technology is useful, that as soon as options started being traded in the market, something new emerged, which was a market for volatility. This is what I'm driving at. I'm saying that, strangely enough, Black-Scholes assumed that volatility is a given, that God is blowing in my ear and is telling me the volatility of that stock is 20%. And then I apply the theory of Black-Scholes and I come up with the formula, with the mathematical formula to evaluate the option, and the theory stops here. The theory doesn't go one step forward by saying, well, with these numbers, now I'm going to create markets for options. And actually what historically happened is that market for options were born after that. And as a result, because options are trading now in a market where the thing that was fundamental, which I recognize as being volatility, will now become a price and no longer a value, suddenly volatility itself became a tradable. So with the birth of option markets, the thing that was only a concept which was the market is something which is volatile, and let's assume that volatility is 20%. So that was a pure conceptual thought. Suddenly, with the emergence of the technology of Black-Scholes, therefore with the emergence of the technology, the reality of derivatives market, as I called them, that number became itself volatile. So volatility became volatile. And this is why it's not as an accident. By definition of putting into usage the technology of Black-Scholes, you are going to create an option market and therefore make volatility volatile, meaning random itself, and therefore break the assumptions of Black-Scholes. And this is why from 87 onwards, people have been trying to develop the next stage of models where volatility is no longer one number, meaning constant, as I showed you, 20%, 50% in my simulation, but volatility itself becomes randomly following another Brownian motion, which is stochastic in itself, and people starting applying technologies of pricing options with models more advanced than Black-Scholes. And I thought that would be the end of the game, when in fact we discovered that now new derivatives appeared in the market, options written on the previous options, and it took the model one step beyond the first one. So there is always a regress. I mean, there is always, the problem gets only transferred from one level to the next with no possible closure. So again, that's what interests me. That is, so it's not a matter of stopping the problem at level n+1 and saying, well, guess what, volatility has become random and that's it. Today in the industry, people stop there. If you look at the latest publications in my industry, like for instance, what Société Générale, who is the biggest player today in derivatives, have published, I mean, the state-of-the-art technologies that they have is a model that is one step only ahead of Black-Scholes, where volatility has become stochastic, and the title of that book is Stochastic Volatility Modeling. And I stop here. But whereas I say, what happened after that is that all of a sudden, I don't know if you are familiar with the VIX index, which trades in Chicago, which they call also the fear index. So the VIX index is volatility. And what we are saying now is that the VIX index itself became a tradable. So the VIX index itself is volatile. So here you are. Now we have moved one level up the ladder above Black-Scholes. So the sheer existence of a VIX index which trades freely in exchange is a contradiction to Black-Scholes, because Black-Scholes assumes that VIX is constant, because it assumes volatility is constant. The mere fact that now we have a VIX index is already an indication that the state of the art of the technology should no longer be Black-Scholes and constant volatility, but should become stochastic volatility. And guess what? Now you have on Chicago options written on VIX that are trading. So what does this mean? It means that to write options on VIX is to apply Black-Scholes on the second level. So you apply Black-Scholes now to the VIX, and now you assume that the volatility of the volatility is constant. But again, if the volatility of volatility were constant, why should you have options on the VIX trading on the free exchange? Therefore, volatility of volatility should itself be random, and so on and so forth. So my whole point is to say, okay, from a philosophical point of view, I cannot content myself at stopping at level n or n+1 and n+2. I have to go to the limit. Even worse than this or better than this, I have to define the market as the place where no matter at what level the latest technology that I have stops, the market happens precisely in going to the next level, precisely in saying, well, if I have stopped at level n and I have the volatility that is constant, then that gives me the value of an option of nth degree of complexity. And if that option now is traded in its turn, then I break the level and I go up one level. So trying to understand the iteration is what ultimately will bring me to questioning the foundation of probability itself. Any question at this point?
Yeah, actually, that was really clarifying for me with my question. I just wanted to say, I don't want to like get into an exchange because others might have questions, but I totally understood the distinction here. and why we can bracket out, when we look at it from that place, we can bracket out Donald Trump out of it.
So bracket out is actually the key word. So I mean, the fact that in finance, finance is a quantitative science. So all we care about is ultimately the numbers. And as soon as I assume that volatility summarizes everything, I don't care what the causes of it are. It could be Donald Trump. By the way, Bachelier, as early as 1900, the reason he introduced what will later be known as Brownian motion is that he said there is at any point of time in the stock exchange an infinity of causes acting. So Donald Trump is one of them. It may be a very important cause as opposed to another, of course, his tweets as opposed to my tweets say, but at any point of time there's an infinity of causes. So therefore, when you say such a thing and you apply statistics, you no longer need to go and qualitatively question what each cause is. You only get the summary of it, which is that something has become random, and it completely brackets out, as you said, or it screens off the real cause. And all we care about is it possible quantitatively to measure or to have a fix or an idea somehow about what the volatility of the stock is going to be in the future? That is the major problem. Now, it's completely cheating if you say, I'm going to infer the volatility from the past, because by definition, the derivatives that the market maker is quoting to the crowd are forward-looking, not backward-looking. Again, to repeat, I mean, the major problem in my industry is the following, is that we are looking at derivatives, and I have a theory of derivative valuation as opposed to a theory of valuation of the underlying stock. There is no theory of evaluation of the underlying stock, because the underlying stock just trades in the market and there is no value of it. As I said, there is only price. But now we came up with a theory of valuation of derivatives, but the major assumption is that we get a fix on statistical numbers, and volatility is the simplest of them, because volatility relates to the simplest random process, which is Brownian motion. But the belief everywhere in my industry is to say that if I have a fix on volatility, therefore I can provide option quotes for the market and make markets. Now, where do I get the fix on volatility? That's the beginning of the problem. It may sound simple to you, but it actually is simple, but it's very deep. A lot of people will tell you, well, I infer it from history, but as I said, it's wrong, because history is not interesting. History is past. I'm looking at the future. So one interesting answer, and even dating back to the dates where I started my career, meaning in the late 80s, where, and you will find this very funny, I'm sure, is that if I cannot get a fix for volatility from history, then I will bootstrap it from the options market themselves. So the only way that you find that in my industry, we know what the volatility of a stock is that I look at the market of options, calls and puts trading on that stock, and I invert the Black-Scholes formula. So instead of feeding volatility in the formula to compute the option value, I feed in the formula the option price as I observe it in the market. I invert the formula mathematically, and I get volatility. And this is what is in my industry called implied volatility. So the irony is that, don't ask me how Black-Scholes came into effect. For some reason, between 1973 and 1987, people believed in Black-Scholes. The industry started, markets became liquid. In 87, the formula completely broke, and the options no longer followed the Black-Scholes formula. But however, the markets were already in place, and on the contrary, the crash in 87, instead of disrupting, it disrupted the Black-Scholes formula, but they did not disrupt, the crash did not disrupt the option market. This is the beauty of the thing, because the option market was already up and going thanks to Black-Scholes formula 14 years before. But the beauty of the thing is that the crash of 87 disrupted the Black-Scholes formula, but it confirmed the existence of options market. All the better now that after the crash, options became truly independent of the formula and started admitting markets of their own independently of a single volatility number. So that's what happened. So 87, on the contrary, was the beginning of option markets in the completely open sense of options no longer being related to a single volatility number, because in that case there is no market. On the contrary, now you had market, liquid enough because banks, everyone was already involved, and from 87 onwards, everyone is using Black-Scholes in reverse. From the start of my career, I never used the Black-Scholes except in reverse. I always used the Black-Scholes by plugging into it the price of options that I'm observing in the market, and I imply volatility, and not the other way around. And of course, I mean, it takes you a second of thinking to realize that if you are doing this, you ask me, what option am I going to pick in the market to feed its price in the Black-Scholes formula, to invert the formula and compute implied volatility? You have on the S&P 500, for instance, 8,000 options trading at any second. Why 8,000 options? Because options are characterized by maturities. So you have different maturities. You have options that expire overnight. So you have 24 hours options that expire weekly, every week, options that expire monthly, options that expire in 3 months, 1 year, up to 2 years, say. And you have the other dimension, which is what in the graphs that I showed you was the strike price of the call or the put. The strike price, I did not say it then, was the price above which you were guaranteed against the rise of the stock, or below which you were guaranteed against the decline of the stock by buying the call option or the put option. So that price above which you are guaranteed for the call option or below which you are guaranteed for the put option is called the strike price. And you have complete freedom on setting the strike price at any level that you want. It could be at $100, $110, whatever. And depending on where the strike price of the option is positioned relative to the current stock price, you call the option out of the money or at the money or in the money. Meaning to say that options, to complete the descriptions of what calls and puts are, you have to specify what is the lifetime of the option. So that's in years, the lifetime of the option. When is the option going to expire? Next week, next year, next month, next year, and the strike price. And if you have these two variables, you end up at any second with, on a market which is liquid like the S&P, with 4,000, 8,000 sometime of options on which market makers are providing you instantly with quotes. So the question is, which of these options I'm going to pick in order to plug its price in the Black-Scholes formula and infer the volatility?
All of them.
Sorry? Yes.
I said all of them.
Yeah, you cannot, because actually, yeah, you're right. What I will show you next by showing you the software that we develop is that you're absolutely right. If you plug, not all of them, but if you plug each one of them in turn and you invert the formula, you will end up with a different volatility from each one.
Right.
Of course.
Esther wanted to ask a question. I'm going to pass on the mic to Esther. Esther, go ahead. Okay, your microphone is off. You have to unmute yourself.
No, I can't hear you.
Go ahead.
Yeah?
Yes.
Yeah, I was just obviously looking at all this from a very abstract point, but then looking at the possibility of, because I don't know enough, of all these possibilities of your thesis of theory are all in relation to a totally liberated liquidity context, or contemplates possible regulations that they are not necessarily repressive, but that actually exist or are part of the options of the volatility. It's that the notion of regulation enters in the
good. Of course, I mean, the only markets that I mentioned are listed markets. So listed markets are pretty much regulated, and you have rules that apply. Okay. And you sometimes, if the market there are what we call fast market. The market has to close for the clearing house to gather the margin calls and all that. So I'm talking about standardized and regulated markets. However, you cannot regulate a market by stopping something to trade at a certain price. You cannot regulate a market by saying, well, the thing cannot go down or cannot go up. You cannot regulate the market by saying the thing cannot go up by more than $10. It can do whatever it has to do as long as it's done publicly. You cannot, And of course,
I was wondering if all these inputs in coming as regulations could actually be more creative, like more, or they are always restrictive and repressive, or taking, the role of experience or statistics or whatever.
No, I mean, today, for instance, today the markets are traded very, very liquidly and very fast, and you have high frequency trading. So there was a lot of concern when the flash crash happened, for instance, and the flash crash happened. Why? Because the algorithms that are doing actually the trading, but mind you, not trading on options, because options are already complex in themselves. You cannot trade in a high frequency way the 8,000 options that I'm mentioning. Yeah, because it's very complex. High frequency trading is only trading one stock at the time. And as I said, you are trying by doing a very fine time scale analysis of what the stock is doing. And even you are trying to do it by putting yourself as close as you can from the stock exchange in order to beat your opponent. So the high frequency algorithms are trained, and sometimes they are themselves self-adaptive. So the algorithm learns as it goes, because it's done also by a neural network. And you have cases also of deep learning where the machine itself comes up with conclusions that no human mind can follow anymore. You do not know what the algorithm has come up with as ultimately probabilistic computation in order to decide in the next millisecond whether to buy or not. You cannot rewind and go inspect what happened. And on the contrary, you are letting the machine itself program itself so that it knows beforehand what's happening. So they thought of regulating that by saying, well, maybe we should put limits to the time scale. Maybe no one should be allowed to trade the stock in the millionths of a second, and you need to trade only every hundredths of a second. But I don't think that works. So you can regulate in this way. But how can you regulate? You cannot stop progress. You cannot tell people doing high frequency trading, no, you have no right to program anything. As soon as somebody has an incentive by saying, maybe if I've devised an algorithm that is a little bit smarter than the algorithm of the previous generation, and even if I hope only to gain 1 cent, not even $1, 1 cent of the next trade, I will do 1 million trades, and in order to gain 1 million cents, right? So that's why the more you refine the time scale, the larger the sizes and the larger the turnover that you need to have, and this is what's happening. And this is what all of a sudden becomes unstable and leads to flash crashes, meaning suddenly some algorithm diverges on its route, it starts selling, and then for some reason it triggers all the selling signals or of all the other algorithms that are more or less the same as the previous one, except that one was faster. And then suddenly in a chain that no one understands, the machines are selling. So, you feel like you want to regulate that, but I doubt that. What can you do? So my prediction is that flash crashes are going to happen now systematically. There's nothing that we can do to prevent unless we stop the market altogether, but this is not going to happen. However, thank God, algorithmic trading and the algorithms that try to forecast the movement, the Brownian motion, if you will, are not the thing that my business is in. This, I don't believe it exists. I don't believe personally, as I said, because I believe in randomness, I don't believe that anyone can devise an algorithm to predict the behavior of something. And on the contrary, to try to guess in the finer and finer time scale can only eventually leads to flash crashes that no one understands. So that's not a dimension that I consider at all. On the contrary, derivatives industry is the one that I'm concerned about. So my problem starts where I just left it 10 minutes ago when I said, please tell me if at every instant I have 8,000 options that are instantly being quoted on an exchange, and that's in a snapshot. So time is frozen. Instantly, I will show you pictures where you have 8,000 options being quoted by market makers. My problem is that I know that I have to apply some theory which is more or less similar to Black-Scholes to invert that theory against the option prices, which option price I'm going to pick in order to imply from it volatility. And the answer was, I'll take all of them. It's exactly what's happening. I cannot not take all of them. So I will take all of them because I now believe that every single option, because it is trading in its own market, therefore it's reflecting some information. So every option is needed in my inversion. And if I invert volatility, the Black-Scholes volatility, against every single option, it's very fast to do on computers. You can do it in less than a millisecond because you just invert the Black-Scholes formula. You will end up with what is called the volatility smile. So the volatility smile, that's it. The volatility smile is the problem that my whole research, both in the company and both in philosophy, is trying to solve, is that I will end up then with as many implied Black-Scholes volatility as there are options. So I will end up with 8,000 different volatility numbers when the whole theory of Black-Scholes was telling me there's only one vol number. Why? Because it's the volatility of the S&P. It's the volatility of the underlying stock. There is one underlying stock, which is the S&P, on which I'm quoting 8,000 options, but the volatility was supposed to relate only to the underlying. So please tell me what's happening. How do you make sense of that? The answer, was found immediately. People are said, well, let us relax the Black-Scholes assumption, which is volatility is not constant. Of course, who is naive enough to believe that for 2 years volatility is going to be 20% and persist even for 1 week? Who is going to believe? So everybody knows that Black-Scholes is not correct. And all the algorithms, the state-of-the-art algorithms that take the 8,000 options today, they take all those prices and invert no longer a Black-Scholes formula, but something more sophisticated, which is a stochastic volatility model, where you no longer can find a single number, you find a few numbers. So the next generation models that are known as stochastic volatility models that belong to the generation after Black-Scholes are characterized by more than one number. Why? If only you want to specify volatility, the volatility of volatility, because we are saying that volatility is not constant, the correlation of volatility with the underlying stock, the maximum level of volatility, because you cannot let volatility go to 1,000, that's unrealistic. So you end up with these kinds of models with at least 5 parameters, and in some cases with 40 parameters. And you can manage with these kinds of algorithms, which I will show you, and my purpose is not to go into the technical details. My purpose is to set the problem for you, which is that even if I succeeded to do so and told you, well, I have now a more sophisticated model than Black-Scholes, which can make sense instantly of the 8,000 prices, this will only move the problem one level up and will end up with options written on the options, and then the model, the smile problem, which will replicate itself at the next level.
And it will be possible that at the moment you will have a certain kind of scientists and programmers, etc., trying to find out ways of doing cartels in between algorithms and capacities of algorithms, like tuning, you know what I mean? Like doing weird, imaginative jumps into the
you have people now doing deep learning in options. You have people who said, well, maybe the options market are too complex to be modeled by Black-Scholes or by stochastic volatility models, and maybe I will have a neural network with 40 layers of neural layers do the job in my place, and I don't want to understand what's happening inside the machine and how is it modeling the behavior on options. So you have people nowadays who apply deep learning algorithms on options, and they tell you, I've read a few articles where they managed to predict the option prices the next day, but then what do they do the day after next? You don't know.
Yeah.
So the reason I like my business is that, again, it's only trying to work not in time, not in prediction. I'm only trying to gather as much information as I can from the instant snapshot of prices of options. And as I said, it no longer stops at that level, because VIX, there is now the VIX index, and there is option on VIX. So I've already have no longer only 8,000 options, but I have potentially 1,000 options on the next level. So we have to build a technology that can go as far as the levels go up. So with no limitation, gather all the information, and the only purpose of the technology is, second after second, give a market maker a way of quoting prices of any option given the options that he knows already. That's it. It's a very modest purpose. The technology, we try to license it to market makers who, if they look instantly at what option prices are trading in the market now, need to generate prices for other options maybe with longer maturities, or options on VIX, etc., in a way, because you cannot generate just any price. You have to generate prices that do not generate arbitrage opportunities. So you don't want, as a market maker, think of the market maker as a bookmaker, if you will, somebody who just publishes odds to the public. You don't want to publish option quotes and have someone who is more clever than you are make money out of you at no risk. In that case, you would have been a victim of an arbitrageur. So you don't want somebody to make money out of you because there just happens to be inconsistencies in your pricing series of options. So that's only the modest purpose of the technology. However, we want the technology flexible enough to accommodate potentially any level of complexity. So that's one thing. So that's the technological challenge. But the philosophical challenge that I have personally is that now, please, someone tells me, can somebody tell me what's happening ultimately? What is this thing that we have on our hands where there is no stability of volatility at any level? Because at any level that I stop, by stopping at that level, I automatically go to the next level, because any level is a level where something is trading. So that phenomenon where I'm saying that there's ultimately no random theory any longer, because any random theory based on probability, you can only stop at some level and make the Brownian motion more complex a little bit, or maybe admit jumps, etc. So I'm trying to, the fact that there is no level at which I can stop and satisfy myself that that is the ultimate model, that is a negative statement. I'm trying to turn the negative statement into a positive one by saying maybe the ontology needs to be changed, and maybe that thing that no longer follows probability because it stops at no level is pointing me to a new kind of technology where maybe I'm looking at the future differently than in probability. Maybe I'm finally looking at the future in the right way. Meaning, what is the right way? Now, if you go to philosophy of the event, like people who like Bergson, or like Badiou, or like Meyassou, or even Nassim Taleb, say that the event is something that by definition will escape any previous framing, any previous list of scenarios that you had. So maybe my answer is that yes, we all agree that the future is too massive and too serious to be framed by probability. So that's why you have a philosophy of the event which extends way beyond probability. All I'm saying here in my business is that, of course, the market of derivatives is not a probability theory. It's something which is practical, something which is real. That's why the whole purpose, the whole title of the class is the reality of option markets. It is real in the same way as I say that the future is real, as opposed to the future is predictable. So to me, events are real. You know, there's a famous saying, I don't know, maybe this is Lacan or Badiou who said it first, is that only the impossible is real, because something that is possible is not real. According to Bergson, what is possible is only a fabrication.
Yes.
According to Bergson, the way that we fabricate forecasts or scenarios is that we look at reality and we just say, well, guess what? Maybe an alternative universe or an alternative possible world is only something which looks very similar to the world that we are in, except for a few items that change. So we only think of alternatives that can present themselves to us by way of varying a little bit a few items that we have arbitrarily selected as variable. Whereas in reality, something totally unpredictable is something that has nothing, no possible way to measure it together with the scenarios that we have. So something that we would have deemed completely impossible, completely outside the scope of possibility. So that is actually the real, as opposed to the possible. And maybe my whole speculation is to say, well, I'm not surprised. It's not without a reason that I don't have probability theory trading in Chicago. I have derivatives markets trading in Chicago, because this is reality, because the derivatives market is something that trades always. The derivatives markets to me is something as real as history. So it's as if history was a movie and the financial markets were the soundtrack of history. So I agree with you. It's very narrow because it's very quantitative. I mean, we are only talking about numbers going up or going down. But my whole purpose is to try to argue that even though finance is very quantitative, it's not a restriction, because you have people who think that finance and derivatives are restricting the future somehow, because it's as if the derivatives market are already writing in advance what the future should be, and therefore robbing us of the future, of our future. It's as if derivatives markets have already put money and numbers against anything that can happen, and therefore it's like a prison, that we are being imprisoned in a world where the future is written in advance. On the contrary, if you look properly at the financial market, but by properly I mean, please go ahead and include in your thinking / criticism of the market, include the massivity of the derivatives market and potentially the endless chain of derivatives written one upon the other. If you go into that direction and apply to that thinking the precision of thought that I can apply because I'm developing a technology precisely to deal with that, you end up with a direct argument against any algorithm and against any idea of framing the future in advance. On the contrary, the financial market, in my sense, which is a market of derivatives, is an argument completely for the openness of the future. So it's as if finally we had a present way of assessing how massive and how open the future is. So that's why I think derivatives are useful, because the ideas are not new. I mean, we all know that a throw of the dice will never abolish chance. We all know that people as early as Mallarmé and surely before have thought about the fact that history cannot be reduced to a throw of the dice. It cannot be reduced to probability theory. So these are ideas that are very absolute contingency. These ideas are quite classical and quite open. But I'm only happy to be able to show through a very neat argument that the derivatives market is one reflection and one illustration of how massive and the future can be. Yes.
Sorry, I don't want to interrupt, but there's question by Tony Opek on the side, and I think maybe we can have him ask them. Would you like to join? You have to unmute yourself, sir.
Yeah. Okay, can you hear me?
Yes.
Yeah, it's just I have several questions on, was trying to frame them in different way, but they all work on the same. That one is that I started with asking if the stock prices actually follow the random walk or Brownian or whatever other random.
Yes.
And you explained that it's might kind of in a short term it's the very kind of most likely description, but isn't kind of, to me, that the power of the Black-Scholes model shows that I don't know, is there evidence that the stocks actually follow Brownian motion? Because Brownian motion, as I understand, is a biological term. It's you know, there's some, I understand some particles in the they move in Brownian motion, but is there any evidence actually that the stocks move follow Brownian motion?
No, I mean, there's a lot of evidence that they don't. But doesn't trouble anyone who is doing theory, because Brownian motion still is robust enough to if you are looking, say, at what's going to happen during a day, yes, Brownian motion can still be a good approximation, because Brownian motion is the only thing that can kill Brownian motion is jumps. So I, for one, I mean, the algorithms that we have, on the contrary, make evident the fact that the stock jumps all of a sudden, so it's not continuous. So by far, the major criticism, I mean, the major evidence that we have that stocks do not follow Brownian motion is evidence that we have that there are crashes and that stock can gap all of a sudden. But as long as you have continuous trajectories, more or less the properties of Brownian motion are preserved. So I'm saying that if you have Brownian motion, but with volatility that is not constant, but itself random, it's still fine, it's still okay. You still can apply more or less Black-Scholes. The most severe test of Black-Scholes is the failure of the continuity of trajectory. And to answer your question, no, on the contrary, we have statistical evidence that you have jumps in the underlying, and even I have evidence from the market of options themselves that you should assume that there is jumps in the underlying. So no, there is no evidence that it follows Brownian motion. Now it's true that Brownian motion comes from Robert Brown is a botanist. The guy whose name was given to Brownian motion is one guy, I think in 1830 or something, if I'm not mistaken, or maybe later, I don't know, was observing the motion under the microscope of pollen particle in liquid. And he observed that the motion of the pollen particle was very hectic. It was so random that at no point could he define a speed. You couldn't define the speed of that motion, because every time you tried to set a direction to measure the speed, the particle will swerve away from it. So he thought this kind of motion was very peculiar, and he took note of it, and he did not explain it. It's only later that people came up with the hypothesis that probably invisible to the microscope even, the atoms of the liquid in which the particle was immersed were hitting that particle, because in those days there wasn't even evidence that matter was constituted of atoms. So some people said, what if really liquids were after all constituted of atoms, and the atoms of the liquid, which are not visible, of course, to the naked eye, but not even visible to the microscope, were hitting the pollen particle and move it and make it move in such a completely random way. It turns out that yes, that's the real truth. So because the atoms of the liquid, because the liquid is liquid, therefore it's not frozen. So therefore the atoms of the liquid are moving all the time, and those atoms are hitting the pollen particle, which is massive with respect to the atoms. Yet the shocks are enough to make it swerve on its path, and this is the explanation of Brownian motion. And it's not until Einstein in 1905 was the first to actually compute a few quantities out of Brownian motion, so define volatility, etc. As I said, Bachelier in 1900 has recognized that the stock exchange should follow something which is completely random at any scale, but he did not connect it with Brown or with Brownian motion. He did not even call it by this name, but by theoretically developing the formulas that he showed in his book, which amazingly enough in 1900 the formulas that Black-Scholes has shown are very similar to Black-Scholes, because Bachelier in 1900, his book was on options. He wanted to compute the premium of options that were already trading in the 19th century on the Paris Stock Exchange. So he ended up, without knowing that the assumption that he was making was called Brownian motion, or will be called Brownian motion, without even defining volatility as a number. He used directly probability formulas without recognizing the diffusion parameter. It was only Einstein who will link Brownian motion with diffusion and with the volatility thing. But Black-Scholes had already showed formulas for calls and puts, because calls and puts existed in those days, which were very, very similar to what Black-Scholes will show 73 years after him. And it's in the 1920 or so that finally Brownian motion was shown to exist mathematically. So what does it mean to exist mathematically? It means that if you assume set theory, which is mathematics, then you can construct Brownian motion. And this was done thanks to Kolmogorov, among other people. If today you go and study probability theory, which was formalized in 1933 by Kolmogorov, why is it so important what the Kolmogorov has achieved? Because he managed to formalize probability that since the day of Pascal everyone was using, but nobody knew on what foundation probability really relied. Everyone thought that probability was a kind of applied recipes that only gamblers would use. And you know that Pascal and Fermat in 1600s were the first to use probabilistic reasoning in order to help out gamblers, players. But they gave no mathematical grounding to everything except applying a few formulas. And it was an open challenge in 1900 that somebody would provide the rigorous axiomatic theory of probability. And it's only in 1933 that Kolmogorov, with a very lean basis, meaning only set theory, meaning to define what a set is and what an element of the set is, and something which is called measure theory also, how to measure the length and the volume of sets, and one more axiom which he needed, which is that you could add the measure of sets in a very clever way. With that, he constructed all of probability theory, the rigorous theory that we know today, and he managed to prove very important theorems like the law of large numbers that everyone was fascinated about. Like, for instance, can you please show me that if I throw the dice infinitely often, then the frequency of the number 5 occurring in the long run will be 1/6. Or if I flip a coin infinitely often, the frequency of heads will be exactly 1/2. To show such very intuitive result, you could not show it except by mobilizing a very sophisticated theory, which is the one that was shown by Kolmogorov in 1933. People had shown, like Bernoulli had shown, things which are called the weak law of large numbers. That was easy to show without the formalism of Kolmogorov. But to show what we call the strong law of large numbers, meaning in the infinite long run, the frequency is exactly 1/2, it required the formalism of Kolmogorov. And it's only after Kolmogorov that you could construct mathematically Brownian motion. And today Brownian motion exists for sure because it was constructed mathematically. Now, of course, it doesn't exist in nature because the pollen particle is only approximately moving like Brownian motion. The stock price is only approximately moving like Brownian motion. Brownian motion is truly a mathematical entity where no matter what scale you refine, it is always random. Yeah. So as I said, the only severe criticism of Black-Scholes is to say that the stock price can undergo sudden jumps. So in that case, Brownian motion is very bad. And like people like Nassim Taleb, whom I'm sure you've heard of, who wrote The Black Swan, his whole book is to try to argue that there is no way that you can model anything like finance or history by the Gaussian. So the Gaussian law is the normal law. The normal law is the fact that everything that is random is more or less statistically distributed around the mean of stuff, and anything that diverges from the mean diverges in the sense of the Gaussian. You know what the Gaussian curve or the bell curve is. So the whole of the book of Nassim Taleb is a charge, an attack against the bell curve. And the bell curve is really the major engine behind Brownian motion. So Nassim Taleb is one person who would argue that in finance there are only jumps, and it's never the case that things are continuous, and not to mention history. So he says history jumps, it doesn't crawl. So history does not crawl on the ground, it jumps all the time. So this whole debate, whether anything moving randomly is diffusing, meaning it's always continuous, or jumps, is the whole debate for or against Brownian motion.
Now, I'm sorry to interrupt, but I just want to say that we just reached the 2.5 hours, but still we're not done. I mean, with half an hour delay, but we did our 2.5 hours. What I wanted to just ask everyone is, ask you, is to, if you can tell us what we should read for next week from the list, the given list. And also, I wanted to ask everyone to please join the Google Classroom, where I'm going to post the sidebar conversation here into the Google Classroom. I'm going to also create our lovely professor an account on the Google Classroom so he can also like maybe go in and if he has time, respond to some of the questions and continue the discussion. So basically, and also like I see another question by Meredith that maybe we can like you decide yourself if you would like to answer it now or later, and that's it. But I just want to say that 2.5 hours I have reached, and maybe some people want to like leave or something. I don't know. I can go on for another 5, 6, 10 minutes if we need to answer Meredith's question.
And again, before everyone goes, I promise that next time I will have the technology online, so I will go back to all of this and show you properly Brownian motion and the graphs, and especially show you the volatility smile and all that. I will have time to sort out the technology, but that's fine, because I think that today, I believe if the thing is recorded, or if you can remember what we said, I think that we've covered more or less the interesting directions that I want to explore. So we will come back to those questions more in details in the next sessions. So yes, what was the question?
What we gonna the question on the side, Meredith, do you want to jump in and propose it?
Do you mind if I just want to say goodbye and thank you very much for letting me join you today, because
you can join us again too.
Do you think so?
Yes. Message me later, we talk about it.
Fantastic. Thank you very much.
Yes.
So I'll see you soon then.
Yes, you. Meredith, do you want to propose a question? Are you around?
Yes. So there were like a bunch of questions in the sidebar.
What about turn your camera on so we can see you?
You got it. There were a bunch of great class. There were a bunch of questions in the sidebar. I think the most recent one was just going over the paradox.
Yes.
That you started the class with. Is it about right now? Right now, the price of an option in the market is correct, but at the expiration date of the market of the option, that because of the movement of the underlying stock or whatnot, that price we thought was correct is no longer correct? Or like, where is the paradox?
No, the paradox is that any technology that we have to price options is based on some formula. If it is Black-Scholes or if it's anything else, it's still a formula. When by definition a formula is going to have an input and an output, and if it has an output and the output you are using it to trade the option in the market, the option price in the next second are going to go away from what the formula is telling you it should be. Because if you are using the formula to trade the option, if somebody is going to buy from you the option, you are going to move your prices.
So it's like it's like a feedback loop.
Yes, if you will. Okay. Except that I don't even need philosophically speaking, I don't even need to wait until the market feeds back on me and moves the price away from me, because initially ex ante, I know that going to the market would have no purpose if the prices were not going to move away. Because as I said earlier, if you go to the market, there is no value, there's only price. So if you apply that postulate to the option, you immediately end up with a paradox. And the irony of the thing is that the option pricing formula, why everyone likes it, because it comes, this is what I said at the beginning, it comes from the previous assumption that the stock price is volatile. So it's ironic because it builds value on non-value. It builds value on the fact that there is volatility, but you end up with the value of the option. And that's why it is resilient, because the best of theories that we have on the stock price is a theory where I'm saying the stock price is volatile, and this theory is giving me option value. But the mark, and people usually, again, in all the narratives that you have, they stop here. Nobody is able to tell you what's going to happen and what sense to make of the fact that the next step is to use the option technology or the option valuation formula in an option market. That's why my whole challenge philosophically, and I will tell you in the next sessions how I have been challenged back by people from probability theory who said to me, no, you got it all wrong, but you have answers already in probability theory. So, but to this date, I still have no answer to how to make sense of the fact that built in the market is the fact that any algorithm, any valuation formula for option is going to fail because I'm trading those options. So this I will expand on in the next session. But again, this paradox, I mean, it's good that you go away with that in mind, is the thing that occupies me from start to finish. Yes.
Thank you.
No problem. Thank you. Any other questions? So yeah. So I mean, I believe that the next session will take it from here, and I'll go back to the to how volatility really this time. I will show you the graphs of volatility and how it relates to options, and I will show you graphs of option prices against volatility, and I will show you the volatility smile, etc., etc. And again, I mean, to give you the end of my speculation, my purpose here is to show that because there is this paradox in the market, it's a reason why a market is a good thing, because it goes for the openness of the future, not against the openness of the future. And it's for this reason that the markets of derivatives are real, are reality. And it's for a reason that maybe a lesson can be quantitatively learned against quantitative probability from the market. So that's what's interesting to my mind in the market. And ultimately, if when in the end I will become very speculative and try to argue why there is something deep in the foundation of probability that can be changed, we can end up with the weird conclusions such as the past, I mean, the future can be written and I'm ex post, even though the event is ahead of me.
Okay, so
it's twist in time.
The only thing left is for you to tell us what should we eat for what should we read for next week?
Yeah, I mean, I think among the papers there is one which is the interview that I gave to Collapse. It's called The Writing of the Market, I believe.
Yes.
I think it's lively enough and it's not very technical, and it gives you really the flavor of what occupies me. So that thing is, I think, is sufficient.
No problem. So that's the reading for next week. If everyone's happy, maybe we can stop the broadcast now. And thanks, Elie, for this wonderful session. And see you everyone next week at the same time. I think next week Europe is still not like gone through the daylight saving, because I think next week will be still something like, yeah, I don't think next week is going to be like because it will be next Sunday. So no, I think you still have that time problem. So then the following week it'll update. Yeah. So just remember to check with Eastern Standard Time for the starting of the class. We will be starting at 11 EST.
No, actually next week, if everything goes according to plan, I will be in New York. So I'll be broadcasting.
Oh, lovely. Okay, so then it'll be early for you. It'll be 11 a.m. for you.
Oh, wow.
Make sure you have really good internet. And actually, if Meredith is on the board of the News Center also as a student representative, and she lives in New York. So you'll be in the same time zone. Everyone also has everyone's emails for extra questions or like big community building and networking. And please join the Google Classroom. And if you don't have a News Center account, because you need to have a News Center email to join a Google Classroom, let me know so we can set up your account tomorrow. Thank you, everyone. I'm going to stop the broadcast. Bye-bye.
Thank you, Mohammed. Bye-bye.
Bye.